Welcome to the Dental School Guide podcast, your ultimate destination for all things dentistry. I'm Dr. Tanner Townsend, your guide through the complex world of dental education. Join us as we uncover the secrets of acing dental school admissions, navigating residency programs, and exploring career opportunities. Please share and enjoy. Real quick, just wanted to make all you pre-dental students out there aware of a resource. If you've ever been worried about getting into dental school or are wanting to get into that school of your dreams, then you definitely want to check out a program called Dental School Guide. In the program, we walk you through how to save money, time, and heartache when applying to dental school. There's so much fluff out there when it comes to resources for getting into school, and we are streamlining all of that. With our comprehensive digital course, expert mentorship, and personalized application review services, you'll have everything you need to stand out to admission committees. Take advantage of this amazing resource that will help you increase your chances of getting into dental school. You'll want to check out dentalschoolguide.com. Check it out. All right, welcome back to the Dental School Guide podcast. I'm your host, Dr. Tanner Townsend, and I'm here with Jake with Dentist Advisors. Jake, we're super excited to have you on the show today. Thanks for joining us.
Of course, I'm actually really excited to be here. This is awesome. I am always looking for an opportunity to educate and lead with that. And so this is super exciting for me too. Thanks, Tanner, for having me on.
Yeah, we are excited to get to know you better. So first and foremost, tell us, Jake, a little bit about what your company does and how you help dentists and like kids just graduating kind of go out into the real world.
So I work for a company called Dentist Advisors. We started up around 2012, 2013 range. We are a dental-specific personal financial planning firm or company, right? So we work with dentists all across the country. I think we're a little over 650 dentists now and different dental professionals that we work with. We have clients in every state. We're still a bit of a smaller group. There's about 4 or 5 of us advisors. We're growing, obviously. But anyway, working with dentists all across the country. We work with recent graduates who are just like, hey, I need to figure out what to do with my money. I have some insurances and student loans coming up, and I maybe need to start into investing. And I just want someone to help point me in the right direction. And we help those people. We all the way until, we work with dentists who are getting to the point where they've had their career, they want to sell their practice, they're looking to transition into retirement. And we help, what does that look like for them? How do we structure all those things and everything in between? And so we're kind of like a catch-all for any financial questions that dentists like to have, jack of all trades, if you will, type of thing. But really any financial questions dentists have, we like to think that we can help point them in the right direction and give them answers. So that's our company and what we do in a nutshell. I know we can dive deeper into that as we go along here. We're talking about student loans and things like that today, but in a nutshell, that's who we are.
That's great. So yeah, we'll probably spin off a little bit into the investment world and kind of how you help people organize their money, because that's one of my gripes with school is they don't ever tell you like, hey, you have this much debt and you're going to be making this much, and then what do you do with the rest? And like percentage wise and stuff like that, how do you go about doing it? So I think those are all wonderful things, especially for pre-dental students and even students that are in their early dental school years to at least think about, because it's a big deal. But first, with your guys' background, let's talk a little bit about student loans.
Okay.
And we're going to go really basic here. What is the difference between the federal and the private loans that are available to students? Because there's a big difference in that realm.
So we'll get into the nuances too. I know Tanner will probably talk about big, beautiful bill that recently passed and all the nuances and how that changes student loans here. But yeah, just starting at a basic level, the differences between federal student loans and private student loans, the differences are pretty simple, actually. Most people want to go the federal student loan route. The reason for that being is you're lending directly from the government. They have more favorable lending terms. You can get, like when I say lending terms, like their interest rates are probably lower right now. Federal student loans, whenever you're taking out loans, they'll hover around the 6.5%, maybe 7% range is pretty typical for the different loan tranches you get for each semester of school. If you want to go privately, because these private companies are taking on more risk by giving loans to students where this debt isn't collateralized, right? It's not attached to an asset, a car or a house or anything they can take. There's a big risk that they're taking by lending to you. And so they will have less favorable terms where they'll increase your interest rate a lot. Of them, you can get rates in the double digits, 10, 11, 12% if you're lending privately. Sometimes it can go as high as that there. So that's the biggest thing is with federal loans, they are more advantageous in general. You're getting a lower interest rate. There are different repayment options. Once you graduate school and are getting in your career, you can lower your payment. They can offer you some flexibility. And again, we can get into some of those things. As opposed to the private loans you're just going with another private lending company. The rates are probably going to be higher. The terms may not be as favorable. It may be easier to go, you're easier to get lending. These companies want your business and are willing to lend to you, but probably less favorable terms than what you get with federal loans there.
Yeah. And I think one of the things that people don't often think about is what is that interest doing during the time that you take it out. So from what you've seen, Jake, with the different types of loans, whether federal, private, or even, like a family loan or like a friend loan, what is that interest doing typically during school and residency program? What have you seen?
Yes, that's a great point. If you're getting private student loans, most of the time interest will accrue on your loans as you're in school, which could be a downside, right? You're taking out your loans for each semester, and that interest is accruing every month as you have those loans, even though you're not making any money and can't pay any of that back. The same thing can happen with federal loans. So when you're getting federal loans, that's like the catch-all term for it, where there are different types of loans under the federal system. There are what's called subsidized loans and unsubsidized loans and grad plus loans and parent plus loans. There's all these different types of loans you can get. Every student is eligible for what are called subsidized loans from the government. So these are loans the government will give you. That subsidized portion means they will cover your interest while you are in school, which is nice. There is a cap, though, on how much you can take there. I wish I had the number off the top of my head. I don't. It's a cap every single semester. They cap you with how much subsidized loans you can take out. It's a pretty low amount. I want to say it's like in the 10 to 20,000 per year range. It's not a ton. So those subsidized loans interest is not accruing while you're in school. The unsubsidized portion, which you can get a larger amount of from the government, still is accruing interest while you're in school. The unsubsidized portion. And same with like grad plus loans as well. Those borrowers, some interest is accruing every single year as well too. So there is interest accrual, whether you're going with the government for a lot of your loans or doing privately. That can still happen while you're in school, depending on the type of loan that you have, if that makes sense. I know we're talking about subsidized, unsubsidized, a lot of bigger terms here, but hopefully that somewhat makes sense there.
Yeah, totally. And I think for most dental students, that subsidized, I don't know about what you've seen with other dental students and dentists you've worked with. I didn't even get offered that subsidized loan. They just said it's unsubsidized and grad plus, and that's it. And
exactly, yeah.
So that's one of the things where just kind of expect that interest to accrue during school, unfortunately. But
one thing on the interest accrual there, Tanner, to maybe ease people's minds here, when interest is accruing on your student loans, it's what's called simple interest, right? And so that means the interest that accrues on your loans, it is just the same amount that accrues every time based on your existing balance. Your interest, what that means, so on regular loans, if you are not making payments and interest is accruing, your interest is then accruing interest. And so that's compounding nature and it's ballooning there. That doesn't happen with federal student loans, which is the nice benefit, is just simple interest. So it doesn't get out of control while you're in school.
Yeah. So let's kind of walk through, if you're cool with it, Jake. You seem like you're good with numbers. Let's walk through kind of a scenario. What does that simple interest for someone that's like trying to understand this and picture this in their head? Let's say a student takes out $100,000 for their first year. What can they kind of expect at let's say a 7% interest rate for a simple, interest scenario? And what would that look like for a student?
Yep. So if you're taking out if you have $100,000 balance on your student loans and a 7% interest rate, they calculate your interest based on a standard 10-year plan. So once you graduate school, you'll have a 6-month grace period where you do not have to make any payments on your loans. Yes, interest still is accruing during those 6 months, but you have 6 months to kind of get your feet underneath you, figure out what you're going to want to do before they require you to start making payments. And then after that point, they will default you. If you don't elect for anything with federal student loans, they will default you into what's called the standard 10-year plan, where you're paying back your loans over to say 10-year period. And so these loans, like the amortization structure, amortization is just a word of how they schedule out the loan. They function on a 10-year amortization. So with $100,000 at 7% over 10 years, you are accruing about $500 to $600 in interest per month. That's the interest portion that is accruing that you can expect there.
That's great.
So yeah, that's $100,000. You have $500 to $600 each month is what you can expect.
Okay. So I know a lot of students have asked me this question. Can you pay on your interest while you're in school to help keep your
Uh,
load down?
you can. Yes, if you like to, you can pay on your interest at any time. This is one of the things you can pay during that 6 month grace period. You can pay during school. The government will let you keep paying off your loans there. I mean, but this comes to a question too, Tanner, of if you're able to pay off some of your interest during school, could you have taken out less loans in the first place type of thing there? And this gets to the point of like, should I work during school? Should I be part-time? Should I not? I know that's a bit of an it depends question. But in short, yes, the government will let you anytime pay towards that interest if you like to.
Mm-hmm. So this is kind of getting in a little bit into that big, beautiful bill territory that we were talking about. We know, let's kind of talk a little bit more about some of those federal loans. Oftentimes, private loans have their own repayment structures where they typically want it within that. They give you a little bit of a grace period, and then they want you to make payments. There's not a whole lot of leeway. But those federal plans, there's several different federal plans. And you mentioned like the 10-year plan, but there's several different ones. What are some of the different plans that are out there, and what can kind of students expect, and how can you switch between plans and so on?
hmm So this is where the big beautiful bill is changing a lot of this recently. So in the past, just for some context, you could do whenever you graduate after your 6 month grace period, you start making payments on your loan. You could do a standard 10-year repayment plan, which again, just 10 years, pay back your loans over that time based on whatever the interest rate at each of your tranches are. You could do a 10-year. You could even do what's called an extended repayment plan, which extends from that 10-year window to 20 years, which gives you a little more flexible window. You could also do what's called a graduated repayment plan, where it gets over 20 years, but you start with lower payments and then it increases every single year up until then. So those are a few of the standard options that were available under the new Big Beautiful Bill. And one caveat I want to make, or not caveat, but note I want to make about the Big Beautiful Bill is this was recently passed. What are we, like a month in? Yeah, beginning of July is when it was passed. They've issued this bill, and now what's happening is the whole student loan space is trying to figure out, okay, well, how mechanically do we make all of this work, right? They kind of issued this bill, and now it's up to the servicers and the government to be like, okay, well, we got to logistically figure out how all these changes are going to be made. So we're still early in this process, and even when this podcast releases, there'll probably be a lot of new information that comes out in the coming months and types of things there. But as of now, with the Big Beautiful Bill, they have changed the standard repayment just to be like a 20-year repayment plan. It's like there's only one standard repayment for you. It's over 20 years. They set your payment on that schedule that you have to pay. Again, obviously you could pay more toward it if you want to, but now there's only one plan there. It's over 20 years, the standard plan they're calling it. And you pay back over that term. You can pay more if you wanted to, but now there's not the option for like the 10-year, the 20, the graduated. It's just one standard payback plan if that's what you opt for.
Okay, so there's no like income-driven repayment anymore with that. It's just
there is too. So that's a separate option. So there's the standard one, but there is still also called our income-driven repayment plan. So this is another thing where some people, for most dental students, when they graduate, what we see, Tanner, you may be able to see something different, but from what we see, the average student debt that I see people graduate with is about $400,000 to $450,000. Is pretty typical. Yeah. These days, the debt we're seeing. So for most dentists, let's say you're in the range if you had $400,000 of student debt once you're graduating. If you were just to be on that standard 10-year repayment plan, your monthly payment would be like $5,000 a month just off the bat.
Yeah.
Which for most new grads, I just don't think is realistic for their budget. Yeah, so to be able to pay that back. And so most people are like, well, crap, that 10-year doesn't work. Even over a 20-year period, that first payment over $400,000 would be like $3,000 to $3,500 a month is what that would look like. That still is a pretty massive payment for new grads who are trying to buy a house or to get married or to figure out their associateship situation, all these things there. And so most of the time, like that standard repayment doesn't make a lot of sense. And so with federal loans, there is the other option to do an income-based repayment plan, which is what we usually recommend for most dentists in the first couple of years of working because it just makes sense better for your budget. And so this is where there's been a lot of changes with the Big Beautiful Bill. There were these previous plans called Save or Repay or Pay or ICR. There's all these different types of income-based repayment plans. Those are all going away now under the Big Beautiful Bill. They're revamping this whole thing. And so with the income-based repayment plans, starting July 1st, 2026, the new plan that they're coming out with is called RAP. R-A-P is what they're calling it. I don't know who comes up with these names, Save, RAP, whatever. I like to laugh that there's maybe a person in the government that their job is to come up with these acronyms. Anyway, RAP plan is what we're calling it. This is Trump's new under that bill, his new proposed plan. It functions very similar to the old SAVE plan that Biden instituted. So what happens if you wanted to get on this RAP plan is they will first take your income and calculate your payment based off of that, right? So there's different planning strategies you can do there. One thing I've seen dental students do is you can apply for one of these income-based repayment plans while you're still in school. So maybe you're in your 4th year and you're like, hey, graduation is coming up. I'm going to apply for this new RAP plan. And the reason why you do that is you can use your previous year's tax return to submit for your income there. So you can say, hey, I was last year,
I didn't make any money.
I didn't make any money. And so if you're not making any money, you can get your payment down to zero, which is nice. Like the ultimate flexibility is I can get my payment to $0 per month is what they required me if I didn't make any income. And so under the RAP plan, if you had a $0 a month payment, again, let's use our scenario. If you had $100,000, right, in student debt when you graduate, again, probably more closer to a lot more than that. But let's say you had $100,000. That $500 to $600 of interest that would be accruing every month, under the RAP plan, the government is covering that interest for you, right? So that $500 to $600 would not accrue or not balloon on top of your loans, which is really nice. So they're saying, hey, make your $0 a month payment. That's what we calculate your payment as with your no income. We will cover the interest for you in the short term. Now, what you have to do with these income-based repayment plans, you have to recertify your income every single year. So every 12 months, once you submit it, they will ask you, okay, well, now that you're a year into your career, resubmit your income to us and we will recalculate what your payment is going to be. All right, so that first year you may get a zero. You don't have to make any payments. But let's say after you're making, $200,000 or so in your first associateship in that first year, your payment would then jump from $0 to, let's say, $600 or $700, right, after that first year of income, and it'll kind of go from there. Again, the benefit of being on these income-based repayment plans is to keep your payment low and flexible while you're getting in your career. You can prioritize other things like saving up to buy into a practice or buying a house or getting married or doing different things. It allows you just to put some of your loans on pause while you're prioritizing other things. There's more we can dive into, Tanner. I know I just talked a ton here.
Oh, no, this is great. And I think this is what our listeners want to hear. So keep it up. I love it. So I guess the next question in line with that, and I think once again, with this big, beautiful bill stuff, it's all like people are still just figuring it out.
Yeah.
I think schools are going to be figuring it out. One of the other changes that I heard, and correct me if I'm wrong here, is now the federal borrowing limit is capped at what, 200 to 250,000, and you just said, like, and you're 100% right, 400 to 450 is the average student debt. So what have you been hearing? Like, are schools going to lower tuition? Because I know that's probably what Trump is hoping is going to happen a little bit. I don't see that. I don't see schools changing that. Maybe you've heard differently than I have, but I still think they're going to be like, yep, it's still due. Figure out a way, whether it's a rich uncle or it's private loans. I mean, what are you guys advising, and what are you seeing on or hearing on that front?
This might be the most controversial aspect of this whole student loan thing with the big, beautiful bill is, yes, what they did is under this bill, they said we are going to cap federal student loan funding at $257,000, like the lifetime cap for new borrowers. So for anyone who's already in school and already borrowing, this cap does not apply to you. This is for everyone who borrows after July 1st of 2026. So for new borrowers at that point. So if you're already in school and doing that, this does not apply to you. But for anyone who have pre-dental school students and things getting in after July of 2026, this would apply to you theoretically. So yeah, this is great. $257,000 is, for most dental school grads, like, that's just not enough loans to cover your full education. As you said, $400,000 to $450,000. And so there's a few different outcomes that could come out of this, right, that we don't quite know yet. One outcome, like you said, Tanner, is maybe these dental schools, like we don't need to call them out by names, but some of these private schools and things like that are going to have to lower their tuition, right? Where it can't be $400,000, they're going to have to lower it down to $250,000. I think that's like the rosiest, that most optimistic in the world, outcome of it. Yes. It's hard to see. I have a hard time believing that would happen, that these schools would just take that massive of a haircut on every single student for the borrowing. I mean, they would have to do that. Maybe they have to go out of business, or people have to take, who work, administrators have to take really big haircuts on their income there. That's like the rosiest picture or outlook on is that happening. Another look would be, okay, well, this is what I can get $250,000 in federal debt. I'm just going to have to take the other $150,000 in private lending, right? Which is, as we've talked about, far worse terms. Maybe your interest rates are a lot worse. That makes that puts more of a burden on students with these private loans rather than federal loans. So that's another outcome. Then the other one could be, yeah, this is just catering to the people who can have parents or family members that can help do loans for them or give them money, which I know people are sometimes they bristle at that, like, well, we're just letting, the more wealthier families, giving them more access to these schools than the non-wealthier families, things like that. I don't know what the outcome is going to be, honestly. My hunch, here's the thing. I don't even know if this is going to actually come to fruition.
Yeah.
Would be my guess. Like, I wonder if this is one of those things in the bill where this is the crazy thing about the bill is a lot of this stuff sunsets in 2028. Like, it's short. Like, it goes
short.
into effect in 2026, and then it sunsets in 2028 when Trump's term is over.
Oh, dang.
I just don't know if this even comes to fruition or if it comes to fruition for like a year or two, and then the new administration comes in and reneges on the whole thing. So that was a long-winded way of saying I don't know what the impacts are going to be, but I would be dubious that I just don't know if this is actually going to happen.
No, and I kind of think the same. I kind of wonder if they look at the tuition or how much they looked at the tuition for like medical and dental school beforehand.
Yeah.
And we're like, you know what? Actually, we're going to make an exception for professional students,
Yeah.
And they may, or like you said, it might just all be undone in 2 years or 3 years from now anyway. And we're just like, it's.
Yeah, or these schools are somewhat pushed back on the, I have no idea, but it's interesting. For the people who are worried about it, I sympathize with you, but it's one of those things we're going to have to figure out as we go along here. Unfortunately, we don't have a ton of answers right now.
Yeah, and I figured that was kind of the case. Are there any other things in that big, beautiful bill that you're like, ooh, a student should know this?
Yes, and so this maybe is not towards pre-dental students, but those who are in school and maybe recent grads this would apply to, which is, so all of the other income-based repayment plans, like this is the SAVE plan, the pay plan, ICR, things like that. Those plans are going away. Mm-hmm. So if you're already enrolled in one of those plans, you're not going to be able to do that anymore. But they are you can stay on those plans until 2028. And so they're going away, but not until that 2028 deadline. So they're giving you a couple of years here to stay on those plans or to get your affairs in order to switch over to that new RAP plan. So that's something to keep in mind there. For all new borrowers after July 1st, 2026, the income-based repayment plan options are that RAP plan that we talked about. It's really the only one. It's either that RAP plan or that standard 20-year that we talked about. Those are the only two options, which is kind of nice. I know, like the student, it simplifies it. Again, the RAP plan has some, I don't know about issues, but it has some changes that are less favorable to the borrower where they're calculating your income on a higher calculation. So your repayment's going to be more than it was on the SAVE plan or previous plans. They're also, that long-term forgiveness that they're giving you is extending from 25 years to 30 years for government forgiveness. And so it's a little less favorable there. So less favorable to the borrower, but they're still getting an interest subsidy, and it's simplifying things. So you can either get on the RAP income-based repayment plan or just do that standard 20-year are your two federal options once you graduate.
That's great. So let's talk real quick. What do you guys typically recommend? I think for a lot of students, it makes a lot of sense for the federal loans first, and then once you've maxed that, go to private. Is that typically what you guys recommend for students in that way?
It is. Again, we've encountered private loans not very often. Mm-hmm. Honestly, like pretty much all of our clients graduate with all federal debt. Again, you can get your unsubsidized portion, like you said, then you can get your grad plus loans, which can cover most of everything else. You can do parent plus loans on top of that, which are still into effect. Again, we'll see how this changes if this new bill comes through and people are capped. But most of the time now we see most people go with federal loans, which is what we'd recommend. They are more favorable. You get a better interest rate. There's a lot more flexibility once you graduate. I would look at federal loans first above all else before looking into the private sector.
I agree. Are there any major mistakes that you feel students make as they're either taking out money, but more I think the mistakes come on the back end where once they start graduating and having to decide what to do next with their money, of whether to pay their loans or to buy that nice Tesla or to buy that $1 million home or whatever the case may be. Yeah. What are some of the common mistakes that you typically see that you would recommend avoiding?
Awesome question. I feel like I can go a few different ways here. I think where I'd want to start is, I think the biggest mistake that we see new grads make would be, oftentimes I feel like they're their biggest stress and their worries, they're just burdened with a lot of decisions, right? They have these massive student loan balances. They're now graduating. They've got to figure out, okay, am I going to go do an associateship? Am I going to work for a corporate office or a private office? Do I want to be an owner? When does that look like? Do I have a timeline for that? Am I buying a house? Am I starting a family? Do I get a new car? There's so many decisions to make. Like once you finally cross the threshold, you start making money. And so I think you can become overwhelmed with how do I organize or plan for all of these things. And so that's the biggest mistake we'd see probably is once you graduate, you get that first paycheck and you just start spending on things really without a plan. Like you said, like you're buying that new car, you're just being anxiously going into a house, or you're paying back a lot towards your student loans. And so it's really simple and sounds easy, but we'd recommend just try and get organized. First of all, it's like know exactly how much you owe with your student loans, know how much money is in your bank account, try and see where all of your financial assets are, and just where do you currently stand. And then try and make a list of priorities of what you want. Like is practice ownership something that you really want to get to? Is that top of the priority list for you? Or is it maybe buying a house or moving back closer to family? Or what is your priorities there and how do you want to categorize those? So get organized, know exactly where you stand. Try and keep your spending in check, at least at the beginning. Like start the habits early. It sounds so like, I don't want to sound like your dad or someone on here, right? That's just like being mean to you. But it's really like once you graduate, you start making a paycheck, start saving early and often is what we'd say. Just build that habit early on where I know it's nice and you feel like, I know a lot of students feel like I've been to school for forever. I'm seeing all my friends driving cars or they already have a house and they have a head start on me. I want to try and make up for all of that. But your future self will thank you if you can prioritize we'd say 15 to 20% savings rate off the bat of whatever your income is a really awesome habit to build and they'll benefit yourself long term. Again, we can get into this, Tanner, if you like, of where to put that money. Honestly, building an emergency fund is one of the first places we'd start. That's not super sexy or exciting, but just put that money away in cash and build that up. You want at least 3 months spending in an emergency fund. Anyway, just flex that muscle. I mean, not flexible, but build that muscle of saving, and saving early will be really beneficial early on.
I love it. Let's kind of dive deeper, like you said, into some of these. Like, let's kind of move from student loans to kind of some of the other things that you guys do as financial advisors. So first, before we kind of dive deeper on like the steps you typically recommend, what you guys had mentioned in the beginning, when you take on a new client, what do you guys typically do? What does that typically look like from where that person is going to start out?
So this actually aligns with what my last answer was. Is whenever someone comes on to us first, we want to figure out, okay, well, we have all these goals and things you want to get to, but before making any decisions about what we want to do next, we need to get really clear about where you currently stand. And so our first step is when someone comes on board is we have an organization onboarding process where we will set you up with an online dashboard. And again, we connect all of your checking accounts and credit cards and savings accounts. We figure out all your student debts or credit cards or mortgage, anything you have there. We want to get all this together and organized in one place. We'll ask for all these financial documents, right? Previous year's tax returns and insurance statements and loan documents and all of that fun stuff. We want to get really clear about where you currently stand before making any decisions about what we want to do moving forward. So that's our first step, is let's get organized. Let's figure out where you stand. And then it's just going through everything. So we will go through together with you of, okay, are there any red flags or things we need to fix? Like, do you have low cash, or do you have maybe a whole life insurance policy or something that we don't love that we need to get out of? Or is there debt to a family member that needs to be paid off? Or, what are the big things that we see currently? We will then go through a budget. What we like to do is say, okay, well, how much are you making? Whether this is associate income that you're bringing in, or maybe you are a young practice owner. We want to look at the P&L and see, okay, what is the practice doing? What's your profitability? What's coming in every month and every year? We want to figure out that number. And then we want to go through, okay, where is that money going? How much is going towards taxes? What's going towards spending? What's going towards debt payments? And then how much can you save, or what's left over? And then it's, what do we do with that money? Is that extra? Is it going towards paying back student debt? Is it going to a 401k or investing? Is it going towards saving up cash for a house? Or, what's the best, what are the best uses of that extra cash? We'll go through insurances too. And we'd like to make sure you're properly covered with insurance, life and malpractice and disability and the different types of insurances that dentists need. I know that's a little less fun. It's one of those just plug your nose, get it over with type of financial topics. We go through that, and then so that's like a lot of the starting is just, okay, where are you now? Where the next best place we can put your money, understanding where you're at, and then let's just kind of keep moving from there. And that's the thing about financial planning. It's an ongoing process. It's not a one-time set and forget it. And so it's really like, let's just set this plan in place. Let's meet again a few months later and a few months later and keep tweaking and changing the plan as we go along.
Yeah, I think a lot of the topics are not sexy. I think the investment topic is often the sexy topic where people are like,
Yeah.
oh, we're going to invest in crypto. We're going to invest in real estate. We're going to do all these fun
Yeah.
things. And it's like, yeah, that's
Yeah.
super sexy, but like you need like that 3 to 6 month emergency fund. You need the, you need your term life insurance. You need the other insurance coverage, malpractice, disability, and all that good stuff to cover you as well, which isn't as sexy, but it's important. Um,
Yes.
so with that, what are kind of the steps like immediately after that onboarding process? What's the thing that you typically tackle first? Is it that emergency fund? Is it like what's kind of the order that you typically take your clients through?
Yeah, for new grads, we would do the emergency fund. So build up some cash. Again, not super exciting or super fun, but it's the right planning move
Yeah.
to do. And so you can use, there's the new things called high yield savings accounts that have become really popular over the past decade or so. You can put your money into a savings account. You can get like a guaranteed return on your money. Right now as we're recording this, you can use like a Betterment or an Ally or Goldman Sachs have an account, and they'll give you like a 4% guaranteed rate of return on your cash, which is pretty nice. Again, this is not life-changing money. This account is not for gain and future growth, but it helps keep pace with inflation and gives you some money while you're stocking it away. And so we'd recommend opening up one of those accounts, putting money away. Start with 3 to 6 months of personal expenses in there. If you're looking more towards the future of, okay, well, maybe I want to buy a practice in a couple of years, we always see what lenders will look for. So when you're buying a dental practice, you don't have to come up with a down payment or anything like that, which is kind of nice, but they do have a liquidity requirement is what they call it. So they want to see, do you have enough cash on hand that shows that you're a good saver, and that also if things go badly in the practice, you can kind of cover things there. The general rule of thumbs are you want about $50,000 or about 7% of the purchase price of the practice that you're buying. And so even working towards that, like building the emergency fund plus funds for maybe buying into a dental practice, you can kind of kill two birds with one stone with that kind of savings process. And so building up cash for that would be a priority. I would start with that first. Again, depending on what your cash flow looks like, if you're in an awesome associateship, maybe you're living at home and you don't have a ton of expenses, maybe you can do both things at once where you can save up cash and also start putting some money away in different assets that are going to benefit you long term. Maybe that's saving up for a down payment on a house. If you really know where you want to be practicing long term, maybe you can get into a house early. I know that's not common. What we recommend is try and figure out what you want to do career-wise maybe before getting into the house, and committing to that might be a smart thing to do. But you can start saving for that simultaneously, looking at different types of investment accounts like a liquid flexible brokerage account or a Roth IRA or something there. Maybe, we can talk about Bitcoin if we want to here. That's fun too. But yeah, start saving with cash. If you have good enough money, left over, you feel like you can get to that 50,000 or so marker pretty easily. Maybe you can start putting money away into other assets too at this time if it makes sense for you.
That's great. So once we've kind of got that emergency fund taken care of and different things, let's talk about what you guys like to typically invest in and where you kind of advise your clients to put their money. What do you guys typically say, and what are some of the different avenues that you have worked with dentists in the past on?
This is another one of those things where I feel like the amount of options we have these days can be a bit overwhelming. Like we're talking about like crypto or real estate or businesses or all these different things that people are like, hey, put your money here, put your money there. I like to break it down like this. In reality, there are only about 3 main asset classes or places to put your money to grow it over time. One is like your own private business. This is like a dental practice that you're investing into, right? It's like you're building up a business that is going to kick off money to you for years to come. Another would be other people's businesses, which are stocks, right? It's like the stock market, public companies you can invest in. And the third is real estate. That has really held its value and grown over time. That's really about it. There's a lot of derivatives and offshoots from those 3 main asset classes, but that's really it. And so we've seen work often for our dentists is a combination of all 3. Typically it does make sense. Now, there's no one right way to build wealth over time. Some people will go all in on their own business, right? These are like to use the extreme examples, the Elon Musk are like the people that they have a business, they build all their wealth comes from this. That can be the same with dental practice owners too. Maybe some people are like, I'm putting all my money into this practice and then I'm doing a second location, a third location, and a fourth, and I'm just going all in on my own private business for my long-term wealth. People will go all in on real estate, right? You'll see this on TikTok all the time. Humans, for some reason, we love the physical, tangible real estate ideas. Like there's something innate in us that we love the idea of having real estate. It's really popular. So people go all in and build a real estate empire to grow their wealth. And they'll do the same thing with public stock markets as, liquid assets and things there. What we see work with a lot of our clients is a mixture of all 3. tends to make sense, where a lot of our clients are practice owners and making money there. They will have some liquid, flexible investments in the stock market. They'll own their own house, maybe a rental property, or maybe they own their own practice building that they're practicing in. Kind of a combination of all three working together, I think makes a lot of sense. But you don't have to. Again, every asset class has its own pros and cons, time commitment, risk appetite type of thing there. And so it depends on your personality. So we try and see what we do is, how do all of these things work together for you? Like, are you a dentist who really wants to buy a practice and become an owner? You don't have to do that, but is that something you want to do? Typically, we would say prioritize that first over these other investments. Your income will be the primary engine and grower of your wealth over time over any other investment. This is kind of the, I want to say, dirty secret of personal finance, but I think sometimes we get misled when you read an article or something like, you need to cut out your coffee and save a lot of money. If you invest early, you're going to become wealthy. I don't know if that's true. What you really need to make a lot of money, to build wealth, is to make a lot of money, right? Is what's going to help you. It becomes a lot easier if you're making $300,000, $500,000, $700,000 a year. It becomes a lot easier. I think everyone can save and invest and achieve financial freedom, but if you want to make it, earn a lot of money and build wealth, prioritize your income. Like, increasing your income is going to be a big help, whether that's getting a better associateship or increasing hand speed or doing CE or buying into a practice. We would prioritize that first. That's going to be the primary driver. Things will fall into place after that. That'll make it a lot easier to save into different types of investment accounts, max out 401ks, buy rental properties. But it stems from what you can bring in. And so we would prioritize that first. So try and figure out, okay, over the next 1 to 5 years, what do I want my career to look like? What can I invest into myself to try and increase my income and things there? We would prioritize that. But also with that too, it's nice. Again, this is the benefit of one of the benefits of investing in the stock market is you can open up a brokerage account or a Roth IRA. We call flexible. So you can access this money if you need to, right? It's not like I'm putting money into a house that I can't really get to. So the benefits of okay, I'm trying to figure out my career. I want to get my money working for me. You can open up a brokerage account, start investing in stocks, and have that liquidity aspect where if you need that money, you can take it out, or things like that. So that's the benefit of investing in the stock market, or at least building up some liquidity. Anyway, I threw a ton at you there, Tan. Hopefully that makes sense. I'll stop there.
I 100% agree that there's really only 3 asset classes. It's other businesses, big other businesses, or real estate. I think you described that beautifully, and how simple it really is. I think we often try to overcomplicate it. So in terms of let's say a dentist that you're working with comes to you and they're like, hey, I want to invest in this asset. I've got a buddy or I've got this oil group that is down in Texas, and they are promising me a $10,000 a month return if I put $1 million in, or whatever. How do you guys help your clients vet an investment opportunity and decide if it's right for them or not?
Well, that's just the thing. That's what we do. We vet every opportunity. So if anyone comes to us, which happens often, right? There's always a brother-in-law or a friend or someone that's willing to pitch you some business idea, and that's okay, right? We are open to that. Again, we have clients who invest in crypto and these private oil futures, or there are a lot of different types of investments you can invest in. And we're not opposed to any of those, but we do want to make sure that it makes sense for your situation. So one of the benefits that we have is, because we've gathered and organized all this data for you, is we can see your whole picture. So we know how much money you have in your checking account and in your savings account. We know what your practice is worth and things there. And so because we can see the whole picture, we can say, okay, there's this, let's use your example of there's some oil future thing that my friend wants me to get into, and they're offering this crazy return. Well, what's nice about having an advisor, not to toot our own horn, is you can have just a second pair of eyes just take a look at this thing, right? Well, they always pitch it in the rosiest, best way, right? This investment. They're promising the world to you. But we can take a look and say, okay, well, what does this actually mean? What we really want to do with any of these alternative type of investments is just my rule of thumb is, if you're going to invest in this, I want you to understand it completely. Right? I want us to know exactly what you're getting into here. So that means how much money are they requiring up front? That is, how long is your money locked up with them? What is the return that they're promising? What are, if you wanted to get out earlier, are there consequences or penalties of doing that? Is there an exact written timeline of when you're getting your money out? I want to know the exact structure of how this alternative investment works before we get into it. We owe it to ourselves to do that due diligence. And so we would look at that, and Maybe an example would be, okay, well, like there's this investment opportunity here, which oftentimes like they may promise all this stuff that may not happen, but there's always it could happen. There's always going to be some inherent risk, right? Which is all with investments you have to understand there. But maybe the conversation goes to, okay, well, there's this investment here, but you told me last week that you actually are like getting a bit burned out at a practice and you want to bring an associate into the practice, and that's something on your radar. And so can we go back to that? Like, what's a priority for you? Do you want to do this investment that's going to take $50,000, or does it make more sense to keep this and like have this cash for this associate you might want to bring on? Is that more beneficial to you? What's more important to you? What are your goals out of this thing? That's the thing with some of these sexier alternative investments is I like to ask, like, just what's the aim out of this? Is this just something you want to get in to feel cool, or to help out a brother-in-law, or to do something there? But like, what's your actual goal here with this? And how does that work with your other goals of maybe growing your practice or spending more time with the family, or we wanted to just involve all these other questions with it. So that was a long way of saying, yeah, we just want to vet it out and ask a lot of questions and make sure that it fits with your situation.
I love that. Now, in terms of tax strategy, this is something I've learned a little bit in my first couple of years. Is like, holy cow, I'm paying a lot in taxes.
Yeah.
This kind of hurts a little bit. What do you guys advise at all in tax strategy and planning at all for your clients?
We do. So we are not CPAs, so we do not file taxes ourselves. But what we do is we do like to do tax planning and strategy, and we will work with your CPA to make sure we're taking advantage of everything that we can. One thing I would say, and maybe your listeners may not love this, but my stance is if you're paying a lot of taxes, good for you. That means you're making a lot of money. It's like, that's the way I would approach it first. I know we hate paying taxes. I know it's a universal thing. It unites all of us. But if you're paying a lot of taxes, that does mean that you're making a lot of money, which is a good thing, right? The one surefire way to not pay any taxes is just to make less money, right? Which I don't think anyone wants to go for and get on that front. The people who are making less money, not paying a lot of taxes, will gladly switch places with you and pay all of your taxes, right? It's that's what I like to lead with there.
Yeah.
There are some easy things that all dentists can take advantage of. Again, a lot of it becomes available to you once you become a practice owner. There's not a ton of flexibility if you're a W-2 employee working for a practice. You can take advantage of a retirement plan, 401k, simple IRA, things like that. There's some personal donated charity, things like that you can do, but it really opens up if and when you become a practice owner. You can do things like putting kids on payroll and the Augusta rule and opening up your own retirement plan. There is some more flexibility in things you can do. I would say for the clients that we work with, if you're making over $300,000, $400,000, $500,000, 25% of your income is going to go to taxes pretty much every year. Like, we'll do whatever we can tax strategy wise. But you're always going to have about a fourth of your income going towards taxes. Just something you need to prepare for. No, again, we want to track your tax number, know how much you're paying every year. It's not super fun. But unless you're like growing and expanding and buying things all the time, buying a new practice every single year, your tax rate's going to be about a fourth of your income. But yeah, we do like to do tax strategy and planning with our clients, make sure we're minimizing as much as we can. That's reasonable. Again, this is also where it goes to other goals too. Like, for example, maybe we're getting too in the weeds here. I'm down, but like an example I'll use is, let's say like someone has $50,000 of extra cash. They have a huge tax bill coming up, and maybe an accountant may recommend, hey, just buy this truck that's over a certain amount. We'll put it on the company, and you can take that $50,000, put it in the truck, and it's going to lower your tax bill by like $20,000 by doing that, which sounds nice. It's like, man, I'm saving $20,000 in taxes. I get a new truck. That's great. But what we'd also want to consider is, are there better places though for that $50,000 than just a truck? Like, can we invest this money? Can you bring on an associate, build out another operatory, do something there with your money that's going to benefit you more long-term and get you more than just the $20,000 short-term tax benefit? And so we always want to make sure that taxes fit in the overall picture too. We don't want to let the tax tail wag the investment dog and all of our other decisions there. And so sometimes the answer is like, hey, I'm just going to pay the taxes, pay that extra $20,000, but then I'm keeping more money in my pocket that allows me to do other things, or maybe go on a vacation with my family, or do different things there. And so that's my small tax rant of, we just want to make sure it fits into everything else as well, that we're not just super obsessed with lowering taxes at all costs, but making sure we're growing your wealth and with that there.
I love that. Well, Jake, if someone wants to get in touch with dentist advisors, one, I know this is always the question that people typically have. What does it cost? Mm-hmm. What does it look like on your guys' end? How do you make money? And then how do they get in touch with you if they're interested in getting in touch with you guys?
So you can just go to our website, dentistadvisors.com is what it is. You can just go there, and on the right homepage, there's a yellow book a free consultation button. That'd be the best way to get in contact with us. It is truly a free consultation. So if you listen to this podcast and you have questions about student loans or debt or investing or anything else, we have people, dentists who call in all across the country multiple times a week. We're just happy to talk to you. I'm sure everyone says this, but we're not pushy salesmen or trying to get you in the door either. We're kind of at that place as a firm where we have people call in who do not want to hire us, but just want some personal advice, point in the right direction. We are more than willing to do that, and we will not try and push you to get into our services there. So that'd be how to get in contact with us. dentistadvisors.com, right there on the homepage, book a free consultation button. As far as our fees and things like that, we're what's called a fee-only advisor. So what that means is we don't sell anything. So we do not sell insurance. We don't sell investment products, annuities, anything like that. The reason we do that is because we want to be agnostic and we don't want to have a conflict of interest where we're trying to push you into any specific product or thing. So we just get paid from our clients. So our clients pay us a fee every single year. That allows us the freedom to recommend different types of investments or things. We're really in your corner, wanting to do what's best for you because you are the one paying us. We don't get fees from any other place or product or thing like that. We have a flat fee is how it works. We kind of charge it yearly or quarterly, kind of like an annual retainer. Depends on what stage you're at in your career. If you start off as an associate, it's $4,000 a year or $333 a month for associate pricing. That scales up to either like $6,000 or $10,000 a year based on your practice size. Then we have an advanced owner that goes beyond that. So it's essentially like a flat fee annual retainer for all of the work that we do of organization and insurance planning and tax planning and investment planning and all of those things there. So if you call in, you can get more detail on what the actual pricing would be for you. But essentially goes to like $4,000 a year, $6,000, $10,000, kind of scale up from there is how it works.
I love that. Well, any final pieces of advice, Jake, before we depart for today?
I would say this may be a weird one, but dentistry is an awesome profession that I would like to remind people of. Like, I know with student loans growing and things that people are concerned, like, is it still worth it to get into dentistry? I would say yes. Again, we work with hundreds of dentists all across the country all the time. I feel like there are very few professions where you can be your own boss. You can pick your own days, work 3 to 4 days a week. You can make a good income. You can help a lot of people in a real big need. You can be like a pillar of your community. I just think dentistry is an awesome profession, and the clients that we work with are really successful and can be happy. And as long as you structure your finances and organize things in the right way, I still think it's way worth it. So if there's any dentists out there being like, I don't know if this is worth it, this seems like a lot of work, student loans are a lot. It's a pretty cool profession and it's a pretty cool industry. And we work with a lot of dentists who are really happy and have awesome lives.
Yeah, I love that. I think dentistry is a wonderful profession. I'm super grateful for it. And there's things you got to figure out along the way, but you just got to figure them out. And then you go on to figuring out the next thing.
Yeah.
So great. Well, Jake, thank you so much for coming on the podcast today. We've really enjoyed having you on. And that is it for today's episode of the Dental School Guide podcast. Thanks, everyone. That's all for today's episode of the Dental School Guide podcast. We hope you've gained valuable insights and inspiration to fuel your journey into dentistry. Don't forget to subscribe to our podcast for more expert advice, inside tips, and engaging discussions. If you enjoyed today's episode, please leave us a review. It would mean the world to us. Until next time, keep smiling, keep striving, and remember, your dental dreams are closer than you think. Thanks for tuning in to the Dental School Guide podcast.